if you're paying federal income tax. What? What am I talking about? Well, I'm here with, in my opinion, America's leading expert, bar none. Nobody else I'd rather take advice from. This is Mark Kohler. This guy has forgotten more about how to avoid paying federal income tax legally than most people will ever know. He's not only a CPA, he's also an attorney. He's a tax attorney. And let me tell you, Mark has saved me literally millions of dollars. He's saved tons of our clients. Untold amounts of money, all completely legal. By the way, I've been through multiple audits since then, since I started working with Mark. And let me tell you something, I've never had a problem. I've never had any issues with any audits. In fact, I'm in the middle of one right now. Don't care. Like, not a big deal. And so I'm saying this because, guys, you need to listen to what Mark and I are going to talk about today. We're going to talk about a lot of different ways to do this. We're going to talk about how to do it easily, how to do it safely, how to build wealth investing in real estate in the process. And we're going to talk about things like accelerated depreciation. We're going to talk about, I know Mark wants to probably talk about some IRAs. He's very passionate about Roths and IRAs and all this kind of stuff. So we're just going to see where the conversation goes. That said, Mark Kohler, so good to see you, brother. I haven't seen you in way too long. I'm glad you made it.
Well, yes. Thank you for having me in that incredible introduction. I'm honored, and I want to let everybody know too, you're in the right spot. This is a safe place. I want to give a little asterisk or a caveat. We want to pursue a tax-free life, but there's a lot of strategies out there, and it is doable. At least there's going to be years where you don't pay taxes here and there, but sometimes you do. I do sometimes, and that's okay. So, but the pursuit of happiness can be elusive as well as the pursuit of not paying taxes. But you're in the right spot.
I love how careful you are with the way you word stuff. I'm just a bull in a china shop with this stuff. I'm like, screw you if you're paying taxes. It's your own fault. Like, I always tell people, anybody using H&R Block to do their taxes deserves to be broke, right? Like, it's your own freaking fault. Guys, there's so many ways to avoid paying federal income tax. To pay it is just, it's ignorance, in my opinion. It doesn't make sense. If you're investing in real estate, there's so many ways and so many write-offs, especially if you're also a real estate agent or real estate professional, as Mark will describe the definition of that, I'm sure, at some point here today. But there's so many ways to do this. Guys, what you need to do is you need to understand enough to have real conversations. Now, I'm not suggesting you don't have to switch CPAs and you don't have to switch attorneys and all that. Obviously, I'm going to recommend you get the right people on your team, because without them, you're just going to pay way too much. And that is the real problem. Is so many accountants out there know enough to be dangerous, but they really don't understand the nuances of this. So, Mark, let's start with this. Mom and pop. Okay. And I know we're going to talk short-term rental properties in a minute and all that good stuff, but let's just talk really quick. Mom and pop that are not even selling real estate. Doesn't matter if they're a real estate agent, not a real estate agent. Let's talk about some easy ways they can reduce their federal income tax burden.
Well, the number one strategy to paying less in taxes and building wealth and increasing your cash flow is having a small business. If you just want to work the day job, there's nothing wrong with that. Work for corporate America, have a W-2, love it. It pay off your debts, live the Dave Ramsey life, and all that, love it. You're not going to get rich. You're going to pay taxes, but there's nothing wrong with that. And you can have a very stable life if you're frugal and careful. But if you want to save taxes, you got to give me something to work with. I can't take write-offs for travel or dining or computers, electronics, cell phones, where I can't write that stuff off unless you have a business. And guess what? Owning a rental property is a business. It's not investment, it's a business. Owning stock, owning crypto, that's investments. Can't write off my home office against my stock gains or crypto gains, but I can against a rental property, and that's a business. Now, if we generate losses there, we're gonna have a deeper conversation. But that's number one. You gotta give me something to work with.
I'm glad you said that. So, okay, let's talk just really quick. And this is going to probably get into graduate level stuff right away. But, one of the things that you've had me do that I feel has been an important piece, but, we've got the trust at the top of of all the stuff that we do. And then underneath that, we've got our Wyoming LLCs. Talk to us for a second about the importance of both a trust, and why do we do a Wyoming LLC filing as a subchapter S?
You go from mom and pop saving tax to a Wyoming LLC. Holy
I know it's a big leap, but I get this question all the time, and I feel like it's misunderstood. I don't think most people even know what a COPE entity is, and I think that's something that would be helpful if maybe you could walk us through that.
Okay, let's get there, because if I go there too quick, it's going to be frustrating for some of you. Let's build a little foundation here, and know where I'm going. It's called the trifecta. The trifecta is a way to look at your overall wealth building and tax savings and asset protection. The Wyoming entity is a piece of asset protection. It's not going to save you taxes. And so we want to look at our wealth with this diagram. And here's what I do this for people worth 100 million, blown away, brand new couple getting married, buying their first home. We use the trifecta. You give it to all of our clients to help build a foundation for wealth and tax planning. This is what it looks like. The foundation is going to be your revocable living trust. We'll talk a little bit more about that. And your 1040 tax return. All the water flows downhill. All your money flows down into your 1040. So we want to use strategies up above and maybe even on your 1040 to save taxes. But all your wealth, all your ownership is going to flow downhill, down to your trust. Then we're going to split your life in half. So this is the first part of the trifecta. This is the foundation, number one. Then we're going to divide your life in half. 1, 2, 3. There's our trifecta. And over here, we're going to put your ordinary income. And this is another way to look at it, is this is your operations. This is paying the bills. This is going to be what you use to generate your investment money, your income, and the starting point. Because we've got to have some income coming in to get the ball rolling. Then over here, we're going to put assets or passive income. And this is where your ass is doing the work. This is where your assets are doing the work. So we want to build this side and bring this all together. So just a typical way, if you're a realtor or a small business owner, a landscaper, a consultant, a dentist, a doctor, whatever, you may have a day job, W-2 as well. You may be married, but typically as we build wealth, we're going to have an entity here. We'll talk about what's that going to look like. Is it an S Corp? Is it an LLC? What is it? But this entity is going to be your operational structure that doesn't own any assets. It's just like a goose laying golden eggs. And it's going to be owned by your trust. Then over here would be a typical structure of an LLC, which are not for saving taxes, but for protection and structure and legacy. And this LLC is going to own your rental property. It's going to be owned by the trust. So we have operations, assets, and all owned by the trust. Realtor, rental property, trust. Now, this is the starting point where then it becomes incredible. And we might have over here a 401k. We might have an IRA. We might have a Roth. We might have an HSA. We might have other entities to hold additional assets. We might have subsidiaries and partnerships and all this, but the foundation is ops, assets, trust. Mm-hmm. So as we continue our talk today, everybody, we're going to go back to this because we've got to put it in our mind somewhere so we can see it. And if we can see it, we can believe it. And if we can see it, we can make it happen. And so we want to build this wealth in a constructive way where it resonates with us and we feel safe and we feel excited. And this feeling gives us the fuel to go out and do it.
I love the way you describe that because, truth be told, I'm 52 years old, right? You start getting about my age. And I think a lot of people think, well, Michael, I don't want to do anything that's going to be a lot of risk and I want to be safe. And yet I still need to figure out a way to retire better than, my Social Security and my meager, 401k that's I got a couple $100,000 in it or whatever it is, right? Mm-hmm. And at the end of the day, there's no better vehicle than real estate, in my opinion. And the way that Mark, you've diagrammed this out gives us not only the ability to invest in real estate, regardless of whether we're a real estate agent or not. It doesn't matter. You can be a doctor, you could be a lawyer, you could be a server at McDonald's. Or I guess they don't have servers, but you get what I'm saying. Like, it doesn't matter what you do. The idea is to create these two sides, because there's so many write-offs you can take by owning a business that you don't get to take any other way. And then there's a lot of write-offs that you get that are even better that you get through investing in real estate and owning rental properties that you don't get in any other way. And then you combine the two, you put them in that trust, all of a sudden you get safety, security, and you get these ridiculous tax write-offs. It's a recipe for absolute building wealth. And by the way, I always tell people, and Mark, I know you're pretty, careful about choosing sides and all this. I'm a little bit outspoken on this, but I think one of the greatest things that was ever said by any politician or any rich person out there was in the debate between Donald Trump and Hillary Clinton, where she says, "You're a crook because you don't pay taxes." And he says, No. That doesn't make me a crook. That makes me smart. He said, that means I just understand the tax code and I take advantage of it. By the way, the tax code that you and your people put in place. No, by the way, so do all your other major donors. They all take advantage of it too. And by the way, if you don't like it, don't hate the player, hate the game. Change the rules. But you won't change the rules because you'll lose all your donors. And the next thing he said really blew me away, and it was so true. He said the system is rigged for the rich to get richer. But here's the thing. You don't have to be rich to take advantage of the system. If we're just following what Mark is teaching, anybody can take advantage of the system. And if you don't, it's your own fault. And I know that's a pretty hardcore stance, but I'm just telling you guys, like, Mark knows what he's doing. And if you do exactly what he's got diagrammed on the chart there and what he's about to explain, it will change your future and very likely the future for everybody in your family that comes after you.
Well, I totally agree with everything you just said, and thank you again for your kind words. This is, I feel this is my life's calling, and my purpose in life is to spread this word, because this is the foundation of the American dream. You can't build an American dream without understanding tax and legal. You got to know the rules of the game, and the rules are there, and it's okay to be strategic. And your number one cost in your life is going to be taxes. And so we can attack it and build wealth and save taxes at the same time. So anyway, we're going to come back. I've got some diagrams. I'll maybe share my screen as well. I can show you some really pretty trifectas that'll kind of blow your mind. But before we go there, strategy number 2. So we got to realize we need to get engaged in building wealth, and that's going to allow us to save tax and build wealth at the same time. That's how the rich get richer. We need a trifecta to build upon. To understand, that would be step number 2, and to have active planning sessions. And I'll give all of you a network of accountants and lawyers that speak my language. I don't make any money on that. I've been training professionals now. I've turned my gaze to the professional community because the accounting industry is on fire. Accountants are leaving the industry in droves. They're burned out. They're scared of AI. Kids are not going into accounting programs. Enrollment's down because they think it's a dead-end job and boring and frustrating. And it's not. It is the backbone of Main Street America, is having a good relationship with an accountant and a lawyer that understands business. So I'll give you some resources here in a little bit. I want you to feel like there's going to be some good podcasts to listen to, because you've got to have that weekly little dose of tax and legal. This is what the rich geek out on. You want to go to a dinner party and talk to wealthy people, they're going to be talking about their tax strategies. They love it. It's like shopping. Here, let me show you how much money I saved. So
it's so funny you say that, Mark. I gotta jump in really quick, because literally what my wife and I love to do in the car, and I know this sounds really crazy, but we just like, when we're in the car together somewhere and when we're, and we're driving long distance, guess what we'll do? We'll throw your podcast on and we'll listen to your podcast and we'll just bounce ideas back and forth. We're like, we really should add that to what we're doing. And it's an awesome way to go deep. So I love your podcast. By the way, why don't you tell everybody what your podcast is so they can go listen to it?
You bet. Main Street podcast, the Main Street Business Podcast. You just go to any of your Stitcher or iTunes or Spotify and just type in Main Street Business, and you'll see it pop right up. Millions of downloads. And we're going to talk about business and tax and legal and marketing and wealth creation and all those little things that relate to Main Street. And so Main Street Business Podcast, if you just put me in YouTube, thousands of videos and downloads there too. And I go live on YouTube every week, answer questions. And sometimes you're like, oh my gosh, I didn't even think to ask that question. So it's a community, and we want you to get engaged there. Now, okay, so let's say you're a brand new business owner. Let's talk about both sides for, could we? So we're going to talk about structure and asset protection and the real estate piece. But for those that have an operational business, let's get one of the key strategies off the table. And Mike, you know where I'm going. Let's explain this S Corp for just a moment. We can spend a whole hour on this or more, but let's just get it on the table. And some of you, you're gonna go, oh my gosh, I gotta have a call with my accountant or get a new accountant when I hear this. So on the operations side, so on the left side, many of you might start out as just a sole proprietorship. That's great. Go out and test your idea, start making some money. You might be a brand new, again, dentist or realtor or online marketer, affiliate. And then you might set up an LLC. That's cool. These do not save taxes. LLCs do not save taxes. It's a structure. We're going to get an EIN. We want to brand ourselves. We want a website, a bank account. That's great. We got to start there. But what happens is when you start to make money in this, let's say you bring in 100 grand and apples to apples, and you have 25 grand in expenses, 25 grand in expenses, cell phone, dining, travel, auto, all those goodies. And we're starting to save tax. Because what happens, here's the tricky, the trick. You're making money and then taking a haircut before you pay taxes. That's step one. If you have a W-2 day job, you make money, you pay tax. There's no additional write-offs that you get to take. So now my effective tax rate goes down. We're going to talk about how to eliminate it entirely. But step one is I got to make some money to go build my assets, to create cash flow, to build wealth, to borrow again, and I get that machine going. So this is the fuel to get that machine started. So I get my entity going, and I'm out there, and I net 75 grand. So I make $75,000. Right? Pretty simple. Bring in 100 grand, spend 25 on writing off everything under the sun. We're going to pay kids on payroll, all these goodies, 75 grand net. Well, the first tax is called self-employment tax, or FICA. What the FICA? We hate the F word, FICA. And this is Medicare and Social Security. And we're going to pay 15% in every state in the country. No way around it. So that's going to be, well, I've got some way around it.
I was just going to say, you have a way around it.
In this structure, there's no way around it. And so we have 15% here. So all of a sudden, we're paying 10 grand in self-employment tax. Then you're going to pay federal and state tax. And you might be in one of the 9 states that has no state tax, but you could be as high as 13% in California, New York, or Illinois. So, oh my gosh, it adds up quick. So we're going to have federal and state, which could be another 25 to 30%. Now, we're taking almost a 40% haircut in taxes with no planning. And you're like, well, I set up an LLC. I watched LegalZoom. They said set up an LLC. There's no tax savings. So strategy number one on this operational side is we're going to get our clients to transition to an S corporation. And I'll tell you when the break-even point for this is, but we're going to just leave it at this. This is a survey. I've got, course, we're just talking 30,000 view. I've got this in my books. You can listen more on my podcast or my YouTube channel. But this S Corp, we're going to make the same 100 grand, spend the same 25 in expenses, net 75, but now I split it. And I'm going to take part W-2 and part K-1. And that's kind of like the profit. And when I cut this in half, now I only pay FICA on this W-2. So W-2 becomes a part of the business expense. And so now I have 37,000 in profit, but I also have a paycheck. You make the same amount of money. We're just going to label it differently. So now I've got this 2 pieces, and I just only pay FICA on this half. I just saved 5 grand. So I saved $5,000. Now that $5,000 could be part of a real estate project in the future. I could fund my Roth IRA. I could use this 5 grand. Then I'm going to start using more strategies to eliminate this income altogether. So this is the first starting point. So every dentist, doctor, realtor, broker, small business owner, online marketer, entertainer, NIL athlete, we're going to be an S Corp. And we're going to start saving on self-employment tax. And when I do that, I go back to my trifecta. This S Corp starts to kick out profit at a lower tax rate. And I have a W-2, so I look beautiful to the bank. And I can start borrowing more effectively with lower interest rates. And I'm going to take this money and deploy it over here. I'm going to live on, and Michael teaches an incredible math of living on less, investing more. And if I can eliminate your taxes, it gives you more to invest. Then your assets create more wealth and kick out cash flow generally tax-free. So we want to create this tax-free wealth over here by feeding our money over here. And this S corporation is where we're going to do it. I'm an S corp. Michael's an S corp. We're all anybody, and here's the break even. Once you start making over $50,000 a year in your operations, we want an S corp. So start as an LLC, then we're going to convert it. Now it's super expensive to convert from an LLC to an S corp. We charge about $300. So it's very, very expensive. Gotta buckle up. But you're going to save so much in money having this S corp, building wealth. That's strategy 5 or 10 or whatever. But I've got 30 strategies, my ultimate guide. But this is one of the key strategies to start that equation. So there, we can go wherever we go next over here, wherever you want, Michael.
No, this is fantastic. You know, I love that you are starting simple, making it clear to people that, look, we've got to take this money, we got to handle it differently, because it's not, you don't even have to go make more money to be able to save a bunch right now. Now, don't get me wrong. Obviously, we want to teach you how to make more money as well, but it doesn't do you a lot of good to go make a bunch more money if all you're going to do is give most of it away in taxes. What you need to do is learn how to play the game right, because again, really the people that pay taxes are the people that don't know the game.
Yeah.
Right? I mean, that's true. And I'm talking about federal income tax. I'm not talking about sales tax and all the other stuff. There's plenty of other taxes you're going to have to pay. But guess what? You don't have to pay federal income tax if you know the game and you play it right.
Absolutely. Absolutely. So now let's go. And Michael teaches his machine here of creating cash flow and paying less in tax. I'm giving you the building blocks, and it should be like, oh my gosh, my account doesn't talk like this. I thought it was more complex. No, it's not. This is fun stuff. So, okay. So now you've got your trifecta. You've got a day job over here. Maybe you've got benefits, your spouse, you, whatever. That's fine. But we've got this machine, this S corp, that's now starting to create more income, whatever that small business is that you're building. Now we want to deploy it. And so I want to use a two-prong approach. I want to be putting money into retirement accounts that grow tax-free and come out tax-free. So I love the Roth 401k, the Roth IRA, and I can take these 401k and IRA accounts and I can buy real estate inside my retirement account. So when I have a retirement account, I'm not talking about Wall Street. I'm not going to go buy crap, that's going to get me a 5% rate of return with an ETF or a mutual fund or a bond or whatever. So I'm going to use my IRAs and my families, and we're going to bundle this money up and create LLCs and buy more real estate. And why I like these retirement accounts is because I'm not having to borrow against them. They literally create tax-free cash flow, and I can still buy real estate inside them, and they're completely asset protected. O.J. Simpson, for those who are a little older, still has his Roth 401k. He still has it, even all of his escapades over the last 30 years. So these accounts are protected from a lawsuit. They create cash flow. You don't have to borrow against them, but you're still buying real estate. Now over here, we want to, on this side of the wall, so this is a tax preferred structure. Then we're going to use kind of a pre-tax structure, our personal investments. So we're going to buy real estate in two areas: inside retirement accounts and inside our own bank account, in our own wealth, in our own name, because it's going to kick out depreciation. And that depreciation is going to allow us to wipe out our income. So that's the secret here, is we're building tax-free wealth with real estate, protected, and we're also buying real estate in our own name that can create cash flow. We can borrow against it, and it's going to create depreciation, and that's the magic. So now we can wipe out our taxable income with quality investments, not bad, throwing good money at bad, throwing good money at better investments that generates tax-free income. And last point, this is why Donald Trump paid $600 in taxes in 2016. The year before he became president, I have his tax return on my laptop. I have Joe Biden's on my laptop. And he paid zero tax because he followed the real estate rules, which we'll get into a little bit. And he was buying hotels and investments that created depreciation, and it wiped out his income on the apprentice and all the beauty pageants and all of his retail. So he ended up zero. And my realtors and brokers generally don't pay tax. As long as they're investing in real estate on a regular basis, they're creating tax-free cash flow and wiping out their income on their S corp.
I can tell you that's why I don't pay tax. I mean, you're right about that. Let me ask you this. So, because I get this question frequently, Michael, but this whole investing with my IRA and all this stuff, it's a pain in the butt and it ties up the money and there's rules and there's process that I got to follow that I don't have to deal with on the other side. But what I'm hearing you say is the number one reason, and I'm really, this is key for me. I'm liking the asset protection side of it, right? I'm really liking the fact that it's really protecting me from loss. Heck, if OJ can protect his assets with it, I mean, who can't, right? But what I'm hearing you say is, hey, look, on the regular real estate side, we need to have enough to completely wipe out our income. Then we should really be looking at our active income. Then we should really be looking at layering in this Roth strategy so that we have not only the piece of our portfolio that wipes out taxes, but then we've also got the piece of our portfolio that provides us with the security to know that this stuff's untouchable.
Yeah. And so many people say, well, because I've been teaching for years, buy 1 or 2 rental properties a year. That's it. This is not a get rich quick scheme that Michael teaches. We're going to just be fundamentally sound. We're going to get out of debt. We're going to buy 1 or 2 rentals a year. And so I have clients call me up, hey, I bought 2 rentals. I'm like, stop, don't do that. You buy 1 rental, let your Roth buy the other rental. You're still buying 2 rentals. And some people are like, well, it's more complex. No, I think it's more complex over here. I've got 1031 exchanges. I got to go get loans. I got to borrow against the money. I got to have a tax return. I have to deal with depreciation. I got to be pretty engaged. When you let your retirement account do it, it's you can't play in it. You can't go stay in it. You can't borrow against it. But it's growing and it's building and you're partnering. And in Michael's partnership program, it's incredible. Your Roth IRA is the partner with Michael, not you. And so it's actually even more hands-off. And yes, you got to use a custodian. We have our directed trust company now has $2 billion this year, Michael. We're over $2 billion of clients' money that they self-direct. I don't make money on it. It's your money. You just park it and then invest it. We're going to help you. Merrill Lynch doesn't help you do that. We do.
Okay, so answer the following question. First of all, that's awesome. That's a great deal. Let me ask you this question. So somebody's investing in their Roth IRA. They're using that in the self-directed IRA to buy some real estate. How then are they? Let's say 6 years, 10 years down the road, they want to pull money out of that and they want to go buy some more real estate. How do they do that?
Well, okay. First, I think the question is flawed, if I may. You're going to continue to buy real estate. You're going to. It's not like, well, I want to pull it out to buy real estate. You're going to keep buying real estate. I want your Roth IRA to buy rental every year, sell one, no 1031 required. You can sell it tax free. Go buy another rental. Okay. Oh, okay. So you're going to build rabbits of these. They're going to grow like rabbits. These little rental properties in your retirement accounts. And so now, what I thought you were going to say is, well, Mark, I want to pull out some income from it. Okay.
No, what I'm saying is, let's say let's say I've got 5 rental properties in this little Roth IRA, and those rental properties have gone up in value, and now there's all this equity in the properties. I want to take some of that equity and go buy some more real estate. But in order to do that, I need a loan from a bank to go get more real estate.
Yeah,
that's the question.
Every bank, Zions Bank, for those that don't know, or Wells Fargo, they have a loan program for retirement accounts. You can borrow real estate in your IRA. You may say, well, I don't have enough money in my IRA. The non-recourse loans require about 40% down. So you're going to put more money down, but you can have terrible credit. Your credit's not on the line. It's a non-recourse loan. Banks will loan all day long. We have a list of banks that are like, send your IRA over here. If you have $100,000, you can buy a $200,000 property. And then if you partner with someone, the ratio can even be different, better. So you can borrow in your IRA, you can buy real estate in your IRA, and it'll grow. And when you turn 59 and a half, it's a tax-free ATM. Sell them. Distribute one of the houses to yourself. Go live in it. I don't care. At 59 and a half, you don't even file a tax return for this. It's tax-free. You want to live tax-free, be building up that Roth. And you're like, well, Mark, I can only put in $5,000 or $7,000 a year. Yeah, start the equation now. You may have an old IRA from an old job. You may have an old 401k. And we can do the mega backdoor Roth. And I'm teaching a group of doctors this afternoon, 100 doctors, on how to do a mega backdoor Roth where they can drop $75,000 into a Roth IRA this year. You can do that. And then and your spouse does it. Now I got 150 grand. And then next year I do it again. Also, Peter Thiel was getting just butchered in Wall Street Journal last year with a $6 billion Roth IRA. He started with $5,000 in 1999. and he invested his Roth IRA in tech, and he did this, he did that. Mitt Romney had $100 million Roth IRA, and Wall Street was like, oh my gosh, it's okay. So you pass go every year, you put a little more in, but your investment return is exponential. So you can build a Roth. We have so many clients with 7-figure Roth IRAs, and when you turn 59 and a half, take it anytime you want, done. Yep. And you may go, well, some of you 30-year-olds are like, well, that's a long time away. No, it's not. No, it's not. It'll be here before you know it. Yeah. And you're going to, and the average American doesn't even have, 40% of Americans don't even have $1,000 in savings, discretional savings, not in a loan, not in an equity line or a credit card, $1,000. 40% of Americans don't even have $1,000. You need to do that, Roth. I want it locked down. I don't want you to touch it. Leave it alone.
Yep.
This is just one method. We got to get into other good stuff.
Yep, keep going. This is great. This is fantastic. Keep going, Mark.
All right. So let's focus. Okay. So we'll leave the Roth. We got the S corp out of the way. One of my 30 strategies. You're going to learn more about that on YouTube or on my podcast. We've got our retirement account. We have a whole podcast just dedicated to this. It's the Directed IRA podcast. So right there, you've got Main Street Business podcast. We have the Directed IRA podcast. And we go through all the steps on our podcast constantly on how to buy real estate, get a loan. Okay, now let's talk about this. This piece is super important. We've got to be buying real estate every year in our own name as well. And this is Michael's equation that he's taught all of you over and over again. But this is the nuts and bolts, because you may try to go explain this to your accountant and their head explodes and says, oh, Michael's crazy. No, your accountant's not educated. So I have built a network of accountants that get this. They speak Mark Kohler. So don't worry. You may have to fire your sister and no longer a spaghetti dinner to get your taxes done on TurboTax. It's time to level up. You want to build wealth? You got to have the right team. So this piece is super important. So now, let's just forget the IRA for a minute. You're going to be doing that separately. Now, let's talk about your real estate. So you have your trust. We can spend the whole time there, right? So that'll be another webinar with Michael. But here you're going to buy real estate in your own name. There's 4 ways to do it. Okay, 4 ways. And there's going to be different tax benefits with these 4 ways. The first one is, most common, is a long-term rental, an LTR, long-term rental. And you're going to create an LLC. You might own it 100% by your trust. You might partner with Michael and own 50% or whatever percentage. You're going to go out and buy a long-term rental property. Okay. And this long-term rental property is going to kick out cash flow and is going to create losses. Rental real estate generates losses on paper and tax-free cash flow, because we might have $1,000 a month in rent, $12,000 a year, but we're going to be writing off depreciation, cell phone, dining, travel, equipment, electronics, home office. All of a sudden, this $12,000 in rent turns into a $6,000 loss on paper. So on paper, you're losing money, even though it's going up in value and you're generating cash flow. And you go, well, how can I have cash flow with a loss? Because the depreciation is a paperless write-off. You're right. The bank gave you the money to buy this, and now you get to write it off over time, and we can write it off quickly or not. So whole other conversation, but the point is long-term rental, okay? Long-term rental, option 1. Now, to take these losses, we're going to have to talk about real estate professional. So we'll come back to that in a moment. Okay. The second option is the most common is syndications, or someone says, I got a fund, come buy real estate in my fund. So they're going to set up an LLC and they're going to try to get people to buy in their crowd fund or SEC deal. If you don't have a fund, you're a nobody now, right? Whatever. But syndications are out there, and these might be called REITs. Stock portfolios buy real estate. So you're going to go be very, very passive. If you're passive in this, you don't get write-offs in this. You're a passive investor. You're in a syndication. That's fine. Go do it if you want. Knock yourself out. The third most common now is the short-term rental. So an STR. So I'm going to Airbnb a property. Okay. So now I set up my LLC. I may partner with someone or Michael or whoever, and I'm going to go buy a short-term rental. Now there's a loophole here. You don't have to be a real estate professional to accelerate these write-offs. So I'm going to be getting cash flow from Airbnb, but I don't have a tax because I'm going to accelerate the write-offs with depreciation, which we'll talk about again here in a moment. And those write-offs can now be used to offset my other income, but I don't have to be a real estate professional. We'll talk about that loophole here shortly. The fourth way to buy real estate, which is very, very common, and Michael does this as well, and I do this as well, is called a self-rental. So you set up an LLC and buy your own building. Your first best tenant is yourself. So if you have an S corporation and you're paying rent to anybody, maybe you have a warehouse, you have a storage facility, you have a storefront, you have a condominium in a high rise, a condominium owned commercial space. Michael owns his own building. I own my own building. My best tenant is me. So if you're in that mix, quit paying rent to someone else. Do a self-rental. Now, what's cool about a self-rental is if I'm renting to my own business, this is a -4 election. Short-term rental is a different election. These are all different ways. With a self-rental, I don't have to be a real estate professional. So I can be a dentist, buy my own building, lease it back to myself, accelerate the depreciation, and not pay taxes for 2 or 3 years. What? Does your accountant tell you that? No, because they don't study this shit. They're got their head in a hole because they, were taught by some old accountant in the corner. We're going to be on the cutting edge of real estate strategies, whether it's a long-term rental, a short-term rental, a self-rental where you rent to yourself. And I'm going to accelerate write-offs here. I'm going to accelerate write-offs here. I'm going to accelerate write-offs here. And meanwhile, make quality decisions on rentals. I want cash flow first. The write-offs come second. Don't chase write-offs. Don't chase appreciation. That'll happen. You chase cash flow. If you chase cash flow, everything else falls into place. And then I can work my magic on your tax returns and a river runs through it. All of it flows down to your 1040. Thank you very much, Brad Pitt. Now, this is an important moment.
Yeah, I love what you said about cash flow because, man, I can't begin to tell you. I say this to people all the time. One of my hard and fast, immutable laws that I follow is cash flow or not at all. If it doesn't cash flow, I don't buy it. I don't care how good the appreciation potential is. I don't care how good the write-off is. If it doesn't cash flow, it ain't happening, period.
And it better be 8 to 10% cash on cash. So if I'm putting down 50 grand, it better be cash flowing at least 5 grand throughout the year. Now, that's after direct expenses. I want to cover the PITI, principal, interest, taxes, and insurance. Then I'm going to write off all the fun stuff. But if I got to cover PITI, I've got cash flow. That's what
I like to see a 25% arbitrage between PITI and rent. And that's aggressive. And when I say aggressive, that's really actually very, very conservative. And it's most people don't have that much arbitrage in their rental properties. I like to have that much arbitrage. It doesn't mean I have necessarily 25% cash flow. I still got vacancy and maintenance, but the reality is that it's going to make sure that I'm fairly safe in that investment. Now, that being said,
you want 25% down payment?
No, I want to have 20 to 50% equity, and that's a whole other conversation. But I want to make sure I've always got a minimum of 20% equity in everything I own. But I'm talking just arbitrage between PITI and rent. There needs to be a 25% delta there. So if I'm $3,000 a month in PITI, my rent's got to be at least $4,000 a month. Again, that's a nice wide.
Nice. Yeah, those are hard to find, but if you find them.
Oh, dude, I'm finding them all the time. My partners, I'm getting, I'm hitting roughly 30 to 60% ROI on everything I do right now. And if I'm doing it with a partner, my partners are getting 15 to 30% ROI. But that being said, that's not the piece that I wanted to dial in on. What I wanted to say is all of the real estate agents watching this right now, let me give you one of a million strategies that can make you guys a ton of money. Number one, on the STR loophole, you should be going to every STR owner in the areas that you serve and saying, hey, look, if I could get you a bunch of money back on taxes that you've already paid, would you take that money and go invest it in some real estate? And guess what? You can call Mark's guys up and you can say, hey guys, I'm going to put you together with this short-term property owner here, short-term rental property owner over here. There, you can go amend those taxes back to 2022, get them a bunch of money back, have them go invest that in some more real estate. You can do the exact same thing with the dentist or any business owner that owns their own building. This is a huge strategy. Go ahead. I'm sorry, Mark. I can see your itching to say so. Go ahead.
Those are good. I got one more. Because see, those are good. But what do you have to do? You have to find someone that owns a short-term rental. Okay. There's a pool of people that do.
That's easy. Yeah.
It's not millions in your neighborhood, right? Number two, I've got to go find someone that also owns their own building. Okay, that's cool. I find someone that owns their own building. That's awesome. How about you find someone with 50 grand sitting in a 401k doing nothing? There's millions of those.
Yeah,
Freaking
absolutely.
best friends have that. They're everywhere. And you go, hey, how's your 401k doing? What are they going to say? I don't know. I don't know. Go listen to Warren Buffett just go off, or even Tony Robbins, on the fees buried in 401ks. And the average rate of return after fees is 4, 5, 6%. It's terrible. So when you go find someone that says, hey, you got some money sitting around in an old 401k? Yeah, let's go buy some real estate. Boom. Boom, realtors. I've given a conference for realtors to just tap into people's 401ks, and they're like, I'm done. I don't even sell single family homes to buyers for their own. I'm just helping people invest their retirement accounts. Now, if you bump into someone with an STR, great. I can save them some freaking taxes. Bump into someone that owns their own building. Great. Let's unlock it. But even better yet, everybody you talk to, just start asking people, hey, how's your 401k doing? And 50% are going to say, I don't know, or I make 6%. How would you like to make 20% in your 401k? Oh, you're full of shit. Yeah, we're going to buy real estate.
Oh, yeah.
Done.
Totally. Absolutely. Easy to do. And 20%, that's freaking easy. What cracks me up, and we got a question from, in the Facebook feed here that I want to ask you in just a second from Nuvia. And that's a great question, Nuvia. But before I do, what cracks me up is average American, what do they retire with in their 401k? What, $230,000, $240,000 roughly in their 401k? And they had to work at that. They probably thought about that, and they put effort and energy into it and got their 3% employer match and woohoo. But then what does the average homeowner have in equity? All they did was buy a single family property that they live in. By the end of their, by the time their retirement age, they've got over $300,000 in equity, and all they did was live in the house. We're not even talking about investment property yet. Like, it just blows me away that people are spending so much time trying to make money in stocks and bonds, all this stuff, when they're missing the freaking waterfall of money flowing next to them, which is investing in real estate. And on that note, Mark, Nuvia asks, can we purchase property with a traditional 401k from a previous employer without paying a penalty?
Yes. Yes. People, when you self-direct, you're not pulling money out of the 401k. You're just calling up Fidelity going, you're fired. And then you move the money in your 401k to directed IRA trust company. People have been doing this for 40 years. It's legit as the day is long, totally safe. You move the money from Fidelity to directed IRA. You move it from Schwab to our trust company. And we're the fastest growing trust company in the country right now. We're not the biggest. We've only been around 7 years with the highest 5-star rating. And it's FDIC assured. This is a normal trust company bank. You move the money there, and there's no penalty, no tax. And then you call us up on day 2 and go, okay, is my money there? Yep, it's here. When we ask you, what do you want to do with it? We're not going to invest it for you. It's up to you. And you're like, I want to self-direct it. I want to direct you to take that money into an LLC, and we're going to go buy some real estate. Okay, fill out this form online. Go to directedIRA.com, go listen to our podcast, and you'll be educated in a heartbeat. And you're going to be going, holy crap, I just unlocked my 401k to buy real estate. Now, what I'd like to just see you do, here's the way you game it. Michael, you'll love this. If you say, well, I'm going to go buy some real estate, and Michael's like, yeah, it's going to appreciate because we buy deals that already have built-in equity because we're buying strategically, and we're going to create wealth immediately out the gate, right? If you go out and buy a $250,000 rental property with Michael, it better be worth $300,000 the minute you close, right? We convert the 401k to a Roth before you buy the real estate, because we don't want that traditional 401k to go up in value to 500 grand, which is great. We'd like that. But when you pull that money out, you got to pay taxes. It's a traditional 401k. So we take that 401k and we convert it to a Roth, and I call it a Roth freeze. They're Dairy Queen as well. But a Roth freeze means you'll never pay tax again at 250 grand. You're done. You paid the tax. It's over. So all that equity Michael's going to create inside that LLC is tax-free for the rest of your life. And cash flow is tax-free. Everything's tax. So you might want to rip the Band-Aid off and pay some of the tax on that 401k if you want. You don't have to. There's no penalty. And so we call it Roth chunking. And we're going to create a Roth freeze. And you'll never pay tax on that real estate no matter how it goes up. So...
yeah, that's huge. And guys, here's the thing. For those of you that are watching this, if you're feeling a little overwhelmed, don't. And let me tell you why. A couple of things. Number one, you don't have to understand every nuance of this all at once. What you need to do is you need to start learning it. You need to start educating yourself. You need to watch this stuff over and over again. Go to Mark's channel, watch his stuff, watch my stuff, come to our events, learn this line upon line, precept upon precept, and give it a couple of years. All of a sudden, you're going to be an expert in this. And in the meantime, just take action. Do something. Go out and buy a property. Go out and let's take that 401k. Let's invest in some real estate. Let's take that IRA. Let's do that. Just take a step. You don't have to be perfect at all this all at once. We will help you along the way. You think of it like this. You're going to build the airplane as you're flying down the runway, right? That's just how it is. But the good news is that we're going to save you loads and loads and loads of money and make your money work a lot harder for you by following these strategies. Go ahead, Mark.
Any other questions we bring them up? Let me put this in one other perspective, and we'll get into a little more of this real estate professional issue. Here's 4 LLCs, okay? 4 LLCs. This LLC is owned by your Roth, your wife's or husband's Roth, your kid's Roth. I love Kid Rock and Kid Roth, and 401k. And you can pool your retirement accounts. You may say, I don't have enough money in my 401k to buy a rental. What's your spouse have in their 401k? What do your kids have in their Roth IRA? I've got I got an LLC that's owned by 8 Roth IRAs. All my kids, we're all together in a little family business with our Roth IRAs. Is your family LLC owned by your family, and your other LLC number 2 is owned by everybody's Roth IRAs? So you have 2 family LLCs. One's individually owned, one's retirement account owned. You can have both. Anyway, so this is option 1. And when I go out and buy any type of real estate, storage units, commercial, short-term rental, long-term rental, syndications, don't care. All of that money is going to go down into your retirement accounts tax-free. Beautiful. So buying stock, bonds, and mutual funds, let's buy real estate. Option 1. Option 2 is you say, oh, Mark, I got an S Corp. I have a building, or I'm a landscaper and I own a warehouse, and I put all my four-wheelers in there and all this. I'm going to rent it to my business, and I do a self-rental. And then I'm going to accelerate the depreciation because it's called a cost segregation. I'm going to accelerate that depreciation, get massive write-offs, and these write-offs I'm going to use on my 1040 tax return. So now I'm generating write-offs, I'm renting to myself, I'm building wealth. Self-rental strategy, option 2. Option 3 is you're like, well, Mark, I'm not a real estate professional. I'm an online marketer, or I'm a sales rep, or I have a day job, W-2. I'm not a real estate professional. I want these losses. Oh, let's do the short-term rental strategy. So as long as I have less than an average stay of less than 7 days, I do not provide substantial services, and I get my rental set up in Airbnb or VRBO, and I have a short-term rental, I have to materially participate that first year, which is about 100 hours. So I'd like buying.
Whoa. Hold on. Are you saying I gotta change the view here? Are you saying we only have to materially participate in year 1?
Uh-huh.
I did not know that. I thought you had to continue to materially participate.
What's going to be sweet is last year, Patty and I, we bought 2 short-term rentals. Mm-hmm. We put in 100 hours getting them ready to go. We had fun with it. We had the kids come over. We're painting. We're fixing up. We put in 100 hours. There's 7 ways to materially participate. So that's one of them. I put in 100 hours, and more than anyone else. I put in my 100 hours. On that rental, I do my cost seg. I ramp it up, all that depreciation in the year I acquire it. And then I take that depreciation and wipe out other income. Okay, cool. January comes around, and I'm like, oh, okay, well, that's done. Oh, I'm going to make it a long-term rental now. Or I'm going to go hire a property manager. And I could still have a property manager the year I put in my 100 hours. They just can't put in more hours than me. So I put in my 100 hours. I unlock the depreciation in year 1. Done. Now I don't have to materially participate anymore because I've already sucked out the depreciation. I can only take the losses in the year I materially participate. So if I accelerate, okay, I don't need to materially participate anymore. I already took all the write-offs. Right.
So basically, if I understand you correctly, what you'll do is you'll take straight line depreciation for the remaining 26 and a half years.
Yeah. And here's what's interesting about a short-term rental. Think about it, Michael, right? The first year, these are going to cash flow. Short-term rental, the goal with the short-term rental is I'm going to get 4x my rental income from a long-term rental. Mm-hmm. So I'm going to have cash flow. And so I'm going to accelerate all those write-offs in the first year. In the year 2, 3, and 4, no depreciation is going to eat up that cash flow. I better have cash flow with my short-term rental. And I want to pay tax with my short-term rental in year 2, 3, and 4, because that means it's profitable. It's making money. With a long-term rental, I can keep that tax neutral for years with straight line depreciation. Now, so that's a short-term rental. And super fun. Love it. Okay. Now you say, well, Mark, I don't like short-term rentals. I don't have 100 hours. And where I live, they just don't work for me. And I can't go put 100 hours in California or Florida or somewhere where I want to have a short-term rental. So that's not working for me. I don't own my own building. I guess I shouldn't buy real estate. Whoa. We can still go get our long-term rentals. Storage units, commercial, single-family homes, duplexes, college rentals, military housing, whatever floats your boat. I'm going to go buy those long-term rentals. And then we have to decide, do I qualify as a real estate professional or not? If I don't, it's okay. All of these losses that I generate are going to go into a bucket, and I can carry them forward for the rest of my life. And when I go to sell one of these rentals, I can dump out that bucket on any rental. So if I sell any rental in the future, I get to dump out this bucket of losses. So some clients are like, well, I didn't write off my travel or my dining because I didn't get the write-off. Oh, you'll get the write-off. I've got a long-term rental bucket of losses I've been carrying forward. And it's just like a warm blanket. So I can dump it out whenever I want. Now, if you do qualify as a real estate professional, I'll tell you the rules in 2 seconds, or your spouse, now I can unlock all those losses. A realtor, you're a real estate professional. Done. But you need to put in 750 hours a year in the industry of real estate. And I have to have it as my primary occupation. I can't have a day job somewhere else and put in the hours. Won't work. I got to meet both tests. Both of them have to qualify. 750 hours, and it's my primary occupation. And then I have to materially participate. Now, that one's easy. It's a lot easier than the short-term rental material participation. But those 3 tests for a real estate professional unlock those write-offs, or I just carry them forward. So people, those are your 4 options.
And when you say it unlocks those write-offs, I think this is key for people to remember. It's unlocking them not only against that rental property and not only against future sales, but it's also unlocking that against active income today.
Because meanwhile, this machine, you're over here with your small business, and you can't make money fast enough because you're like, to buy my other rental. And then that's going to create more cash flow and tax rate. Oh, I got to make more money. And so all of a sudden you've cracked the code. You're living the American dream, building tax-free wealth, asset protected, and it becomes a game. And it's so right. And you've gamified the tax code. And so you're trying to be as efficient as possible to scale and maintain, maybe even exit a small business. And you're growing that and teaching your family about legacy and building wealth. But then you're not going out and buying a third home. You're not going out and buying a Hummer, a new, BMW. You're living frugally, and you're taking that money and deploying it.
Okay, so Mark, we're running a little bit short on time, but I want to ask you a couple of questions really quick here that are very important on accelerated depreciation. Now, I always like to tell people, I don't care what your politics are. I don't care if you're conservative or liberal or, if you're Christian, Muslim, Jewish, black, white, Asian. I don't care about any of that crap. What I care about is money. Can we be nice to each other? Can we help each other? Like, those are things that matter to me, right? But this got passed. Donald Trump got this accelerated depreciation passed in 2021, took effect in 2022. 2022, we could take 100% of this deduction. Correct me if I get any of this wrong. 2022, we could take 100% of the deduction, and there was a sliding scale, a sunset period between 22 and 27, where 20% per year dropped. So in 23, we could only take 80% of that accelerated depreciation, and the rest had to be taken over the rest of the remaining 27 and a half years. So you're still getting benefit. You just have to take some of it. You get to take some of it sooner. Some of it needs to be spread out over the 27 and a half years for standard or for straight line. The question that I have, first of all, did I characterize that correctly?
Yep. And now that it was 60% last year and it's 40% this year, it's going down. Right. If we could only elect a real estate investor as our president, that would be crazy. But anyway, keep going.
So here's the big question that everybody's asking is, now that Trump's in office and now that he controls the Senate and the House and the judicial branch, do we think that that's going to go back to 100%? Do we think it's just going to sunset and go away, or do you think he's going to lock it in somewhere in the middle? I have an opinion on this, but I think your opinion is much more valuable than mine. I want to hear yours.
He's told us he wants it back to 100%. He wants to bring back the Tax Cuts and Jobs Act from 2018 that created this depreciation write-off in the first place because it stimulated the economy. We had our best 4 years in the real estate community while he was president. Then it starts to go away. And he said, if you elect me, I'm going to bring it back. I want to bring back the Tax Cuts and Jobs Act. I want to bring back 100% depreciation, opportunity zones. I want to bring it all back, and we're going to save more taxes and stimulate the economy. So I can't wait. I'm working on my third edition of my book right now, because the minute the new tax code is passed, I'm dropping my next book again.
Yeah. Oh, that's smart to do that. Here's my question, though. So I get that he said that, but pre-election, have you heard him talk about this since the election? And the reason I'm asking this is because, I keep hearing this, and I think I can imagine what you're probably going to say when I say this, but I hear this, oh, we're going to tariff everybody and we're going to wipe out the income tax altogether. There's not going to be an IRS and there's blah, 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 blah. I'm not sure that's realistic, frankly. And honestly, I think he's posturing. I think he's just doing that to accomplish some other goals. But I am questioning, is he really going to take it back to 100? I hope he does. I would love to see it go back to 100. But do you really think he's going to bring it back to 100?
Oh, yeah, absolutely. Okay. Yep, I do. Now here, those that follow Trump and know him and love him, know that this is his. I love the word you use, posturing. Yeah. What did Trump always do? He said something over here to be extreme, get everybody's attention, and get everybody freaking out. And he ends up,
we're going to take over Canada. They're going to be the 51st state. Yeah.
So he's going to say, we're going to get rid of the IRS. No, we're not. We're not going to get rid of the IRS. We got to pay some bills. It's called Social Security and national defense and all that. Now, could we bring down the tax rate? Sure. He did with the Tax Cuts and Jobs Act. Is he want to bring back 100% depreciation and all those cool write-offs that came with that? Yes. But he'll start extreme to get everybody over here, and then we'll settle back somewhere that makes sense. And that's how he works. And it's okay. I know that his rhetoric sometimes bugs the hell out of some people, but just he's your guy. That's the cool part. You may not like the quarterback on the field. That's okay. But that's your team. Get behind the quarterback, because all he's trying to do is make it better. You may not like his style, the way he does it, but and here's the one, like I was going to, got gut filled. He said this too. It was so good in a commentary. He said, if you're going to go into a lawsuit, you want the meanest, toughest lawyer out there. If you're going to negotiate with China, I want the baddest ass jerk that's going to go fight for me and go get tariffs and quit letting people take advantage of us. Do I have to like that attorney? No. I'm going to hire a badass because I want them to go kick butt for me. But I don't have to love them. I'm elected a politician that's soft and wonderful and kind. And I'm going to go hire someone that's going to kick some ass for me.
That's right.
So anyway, I didn't mean to get too political, but the tax.
I'm right there with you, though.
The tax code. We need someone that's going to go hard at the tax code, get us our benefits back. And he's promised he's going to do it. And he's already following through. And everything he said he's doing, people are freaking out. Oh my gosh, he's doing this with immigration. That's what he's going to do. Yeah. So quit freaking out. He said he's going to change the tax code. He's got people working on it already. It takes a while to write. The Tax Cuts and Jobs Act was 550 pages. Give him he's going to get it in 3 weeks, people. Give him some time. It's going to come.
I'm excited to hear that. So, Mark, the second that comes out, with whatever the number ends up being, whether they go back to 100 or they lock it in at 50 or whatever they end up doing, I want to do a webinar with you the second that comes out. We need to make sure the word gets out on that because, and I'll tell you, if it goes back to 100, hallelujah. So here's the last question I want to ask you before we wrap today up, and then we'll schedule another one. I know you've got a meeting you got to get to as well. But here's the last question I would say is, if someone is thinking, well, Michael, if it goes back to 100, I don't want to accelerate my depreciation yet. Do I? Should I wait? And if I have the ability to accelerate stuff from 2024, should I be waiting until 2025 thinking that it might go to 100% in 2025? Or should I just go ahead and accelerate the 2024 stuff And then if it goes to 2025, amend my term returns or something of that nature. What would you suggest?
Um, Great question. The first question, even before that, is should I even
Right.
excel? So many people, they see cost seg and they just run like with their heads cut off right into a cost seg analysis. They can be expensive too. And then they find out, oh, I don't get the write-off. So the first question is always, do I even need a cost seg? We might want to spread that depreciation out over time. We don't need to go eat all the ice cream on day one. Let's leave some in the freezer. Let's be careful. We don't have to overdo it. So that's an important strategy. And I'm going to give everybody our network of accountants that speak Mark Kohler that train with me every week. And I put them through 900 quiz questions, 70 modules on taxes, on crypto and real estate and small business and asset protection and estate planning. You're going to get someone that really knows. They're a certified tax advisor on Main Street. That's my program. So you can buy it if you want, people, but just hire someone that's been through my rigorous training.
Right.
So, okay. So number one, should you even do cost seg? Then, what happened before and which we expect will happen again, if you're filing your 24 tax return and we can use some cost seg and accelerate, then let's use it. If the new law comes and they ramp it from 50 to 100 or 40 to 100, wherever it's going to fall, we can go take another bite at the apple. And so
that's what I was wanting to hear.
Yeah. And you don't have to amend your tax return. We'll just take that depreciation in 25. So in 2025, oh my gosh, it's gonna be like a candy store. I can't wait for this new tax code to come out. You can't.
Oh my gosh.
It's gonna be awesome.
I am so excited. You can't even get it. Dude, I love all of this. Mark, you and I could talk all freaking day long about this stuff. We'll get another one of these scheduled very soon. I know you're checking your schedule to see if you can make it out to LABC. Well, in April, we'd love to have you at that event, but that we got to work out schedules for that. But at the end of the day, guys, you need to go follow Mark. Mark, where do you want him to go? Where do they go to get more from you?
A great starting point is we've already talked about the podcast and YouTube. Start some learning.
Let me give them that link too, by the way, before I forget. clubwealth.com/CPA to get more information about Mark and about his products and getting connected with his accountants and all that. But go ahead, Mark. What are you going to say? Keep going.
Yeah. So we've got the podcast, YouTube, all the social media channels. I look for the blue check mark. I'm posting daily, all sorts of tips and videos and good stuff. Number two, when you're ready to take action and get a consultation, our law firm is a great place to start to just get your trifecta built. Get a plan. Find out, are your entities in good condition? Where are they set up? Are they properly maintained? We'll talk about this Wyoming strategy. We're going to look at your asset protection, your trust. And we have a comprehensive estate plan that includes a trifecta. We'll set up an entity, include a trifecta. Get a lawyer on your team to just review everything out. You might spend a couple grand, but we're not charging $10,000, $20,000 for this. It's going to depend on how many moving parts you have, maybe $2,000 to $4,000 somewhere in there. I don't know. But get a call, make a phone call to KKOS lawyers and just get a consult, get a review, and then start there. Now, if you're like, well, I just want to go straight to my tax prep. I need a good accountant. I need a good advisor. When you're at markjkohler.com, so go to markjkohler.com, and under services, you'll see the Tax Pro Network. And it's like a LinkedIn page with hundreds of accountants certified by me in order to be on there. And you're going to find that accountant, and then they're going to work with the lawyer. So now you've got a team that speaks the same language. You get your trifecta built, and all my accountants can build a trifecta as well. So they're going to onboard you, look at your QuickBooks, look at your last year's tax return, and they're going to bring together the legal and the tax. And it's magic. And immediately, if we don't save you, and I say this all the time, if we don't save you in taxes in that initial consultation, we'll give you your money back. Like we literally will. We're going to save so much money in that, and we never get back money on this. People are like, oh my gosh, I need more of this, because they know, Mark, every time I'm on a phone call with you, I make more money than what I paid. And
100%.
So start there, markjkohler.com, KQSlawyers.com, get over to the podcast, get to the network. We're not going anywhere. And we're going to live that American dream with you.
I love it. Mark, I appreciate all the value you bring. Every time we talk, I get more, and I learned stuff today that that I'll be teaching now too. So very exciting. Go ahead. What you say?
No, thank you. Thank you. I'm so glad to be here. Thanks, everybody. And we're going to be doing this every other month. And I want to get to your event in Nashville. So get me the dates on that. See if I can make it work.
Will do. 100%. Awesome, man. Thank you, Mark. Everybody, comment, like, share. Guys, get this out there. People need to hear this. Nuvi, I appreciate your question, by the way. And guys, if you have more questions for Mark, ask him in the social media feed that you're following here, and we'll do the best we can to get Mark tagged and get him to answer those questions for you as well. Have an awesome day, everybody. And Mark, thank you again. Take care, brother.
Thanks.
Club Wealth is the only coaching company on the planet that will literally guarantee that you will double your income or make at least an extra $100,000 your first year coaching with us, or we will give you 100% of your investment back. Click the link below, sign up for the appropriate tier level, and let's get you a strategy session today. And I promise you, I 100% guarantee you, promise you that you will walk away with a heart full of gratitude for the time that we took for you, because you got so much value out of that call. Schedule your strategy session today. I promise you'll be glad you did.